Hello from Trend Signal for our review of the data and events the week beginning the 13th of June. Monday morning, we greet the markets with the Nikkei down 3.5%, Hang Seng down 2.8%, Shanghai down 2%. So really there's a bit of a carryover from Friday's moves in equities with a big sell-off, with bond yields continuing to fall. In fact, the headline last week was really towards the end of last week, really, as global bond yields collapsed amidst a rush for safe haven mode, as you call it. We just see the headlines on the various outlets. Financial Times, bond rally breaks record as investors race to safety. From Bloomberg, bond yields around the world fall to records and growth outlook. I think you can throw Brexit into that mix as well. But we've seen record low bond yields, remembering that price moves inversely to yields. So we saw record low yields on major sovereign bonds such as bunds, JGBs, gilts. Japan is marred in negative interest rates with the 10-year JGB well into negative territory, which means you lend money to the Japanese government, you're guaranteed of getting back less than you lent. And now the 15-year JGB is getting close to negative, which is just extraordinary. The German Bund, the benchmark for Eurozone bonds, that hit an historic low yield of 0.015%. Looking at what you get when you give the German government money, you'll get back 0.015% per annum for 10 years compounded. That's 0.1551% gross over 10 years. And people wonder why negative interest rate policy is bound to fail. I think many are losing faith in the system, really. In fact, Bill Gross, the founder of PIMCO, who's now at Janus Capital, warned on Thursday that the bonds yielding negative interest rates, which now total, I think, well in excess of $10 trillion, is a supernova that will explode one day. I think there's slight confusion in terms there. I think a supernova is an exploding star. Not sure an exploding star can explode again, but I think it paints the right picture, though, of an accident waiting to happen. Of course, the UK gilt market also joined in the panic to buy bonds, mainly because part of the reason for the risk-off mode, safe haven buying, was due to the increased risk of Brexit happening, not just global growth concerns. Gilt yields, for the record, hit a low of 1.217%, which is in itself a record. Obviously, if Brexit were to happen, gilt yields, sterling and bank interest rates will surely head lower. As for Europe, not sure what's going to happen. I guess they'll either bring up the drawbridge or the dissatisfaction will spread from country to country. Spain, Italy, Greece and even Germany will see increased criticism from the populist anti-EU parties. So there we go. Obviously, safe haven buying also means on the other side of the coin we see risk-off selling in equities. Friday saw one of the worst sell-offs since February. Having started well, the US indices posted, the S&P 500 index, I should say, posted its first weekly drop in 4 weeks. The VIX index, the fear and greed gauge on the market, that jumped 16% on Friday to a 3-month high. So I think that really underlines the concern that the market's feeling just at this stage where we're 10 days or so away from the referendum on Brexit. Obviously, the dollar, that rallied amidst safe haven buying, really reversing losses from earlier on last week. Sterling, well, that was talk of the town on Friday. A sudden move against the euro and the dollar was down to the ORB poll commissioned by the Independent that had the Leave campaign 10 points ahead, which is the biggest margin of any poll. I think if we see that supported by other polls this week, we could well see sterling against the dollar slip below 140. Weekend polls were mixed, with one showing the vote evenly split with another 2% lead for Remain. But the uncertainty continues to hit sterling with further safe haven buying of gilts. We've already witnessed a move on Monday morning down to a low of 141.47. 141.57, I should say. So perhaps more of that to come. As for data this week, a lot of data out this week, inflation data, plus central bank meetings, which really dominate the calendar, although, to be honest, we don't really expect too much in the way of any change from these. But let's have a look at them anyway. The first one being the FOMC meeting culminating on Wednesday at 7 o'clock in the evening. That's the rate-setting committee of the Federal Reserve, the U.S. Central Bank. Since non-farm payroll 10 days ago, expectations have really shifted on the timing of any rate rise. I think the probability of a rate rise in June has slipped now to below 2%, so that's just not going to happen. But we do expect Yellen to keep open the possibility of a rate hike in July, which, as she has stated and continues to state, has always been data dependent. But I think the likelihood of a July hike is now 22.5%, which really leaves December as the preferred month for a hike. Obviously, with elections in November, there won't be any change in rates around that, certainly in the lead up to it, which would mean if we do get a hike in December in the US, it would be exactly a year after the last hike, which is a very gradual rise in rates, which is what Yellen was suggesting, although maybe not the very. Thursday, we have the Bank of Japan. Thursday early morning, obviously. The nightmare for the Bank of Japan continues as the yen rallies again in this risk-off move, certainly accelerating towards the end of last week. Not that the yen was falling any faster towards the end of last week, but it has been noticeably strong over the last 10 days, which is not good for the Nikkei and those Japanese exporters. The consensus for the Bank of Japan to leave interest rates unchanged, especially so ahead of the upper house elections next month in Japan. But there are some economists who are warning that the central bank could still surprise the markets, and because it likes surprising the markets. Oh, and we also have the Swiss National Bank on Thursday early morning. No change expected there. And then we have our own Monetary Policy Committee, our rate-setting committee of the Bank of England. The Bank of England is expected to leave interest rates unchanged, not surprisingly. I think it would be unthinkable for the MPC to make any adjustment ahead of the referendum, although unlike the government, there is no restriction on the Bank of England commenting on the effects on the economy of a vote to leave, which I think Mark Carney is highly likely to do, as he has done so in the past. So no change for the central banks, which really leaves the rest of the data to look through. Inflation data we have in the UK. We've already had, we have inflation data on Tuesday. We're expecting a figure of plus 0.4%, which is a slight uptick from the previous data. On Wednesday in the US, we have the sort of leading pricing data, the producer price index with the cost of goods and services going into production. Certainly no signs of any inflation brewing there at all. And in fact, then we have to jump until Friday to get the US CPI data. Core CPI data plus 0.2% is the consensus, same as the previous month. The core one excludes more volatile components, so they released two versions, the core and the regular CPI. But in fact, I think the manufacturing data is something the Fed would be looking at more closely. They seem to be more interested in employment and manufacturing and service sector activity rather than price and inflation data, really. So perhaps Thursday afternoon at 1:30, there may be a bit more interest from the Fed and from the market in that particular data. And that's it for the week, really. Thank you very much for listening. Bye for now.
If you would like more information about trading the right way, Trend Signal is giving you the opportunity to see and hear about its services live at a free online seminar. Take a look at the Trend Signal website for the latest events and to book your free place.